Stock picking and investing in index funds both have done very well for investors, but they do have their differences, and if you don't know how to approach them, you could be in for some serious trouble. In fact, Warren Buffett's ability to pick stocks has allowed him to amass a net worth estimated to be $130 billion. And with all of his experience starting at age 11, he actually recommends that for most people, the best thing to do is own the S&P 500 index fund, which he specifically says the trick is not to pick the right company, but to essentially buy all the big companies through one fund that is the S&P 500, and to do it consistently, which comes at a very, very low cost. But this may not be entirely for you, because if you are one eager to outperform the average stock market returns, you're going to have to invest differently. Now, studies show that in bull markets, index funds are known to be the favorable investment because they can provide attractive returns as the markets rise, lifting all boats. And then for bear markets, many reports believe to say that active managers, which are ones actively picking stocks, may provide investors with downside mitigation when indexes are in a sharp decline. So the concept behind this is that if your investments are actively managed, or you have the time and expertise to manage your own portfolio, that you could potentially reduce the risk of losing money in a bear market because you could quickly adjust your positions to avoid the significant losses. Although I'm not a true full believer in that approach, if you are investing into index funds, the difference is that if the markets go down, the index is going to follow directly. Which, if we were to look at the worst years in the US stock market, you can see numerous years where the S&P 500 declined 20, 30, and even 40%, where in 2008, from the Great Recession, the fund declined over 36% in that year alone. That pretty much means that if you had $100,000 heading into that year, by the end of it, it would be at roughly $63,000. And say something came up in your life and you needed the cash, if you were to sell at this point, it would be among the worst time that you could sell. And if anything, because index funds are meant for long-term investing and have historically done very well, especially the strong index funds like the S&P 500, you would want to continue buying more and more, especially when it's at the bottom. Which, if you didn't know, the S&P 500 has consistently grown over time as the US economy develops, where you can see approximately 72 out of a total 98 years have returned positive. Which, even better, since 1928, the fund has averaged a 9.9% annual return. But like I said, the sole focus with index fund investing is for the long term, so you should not worry about short-term fluctuations. Although investing and having the patience to wait a long time for your investments to compound is boring, but it's extremely important for your financial future, especially if you want to retire one day and have your money work for you. So just a simple example on how well an index fund could have done for you over time. If you invested $500 per month in the S&P 500 and let's say averaged a 9.9% annual return, not including inflation, but after 30 years, your investment would be just over $1 million based on historical returns. And although it's off topic, it's extremely important, but that could be 100% tax-free. You can invest into dividends. You could take income however you want if you were to do that within a Roth IRA, because you'd pay taxes upfront on what you contribute throughout the years of investing, and at the end when you withdraw, if you do everything properly, you can avoid taxes completely. I made many videos related to investing in the stock market and a Roth IRA, so if you want to learn more about that after this video, I'll have those linked in the description below. Which, if you are finding value in this content, I'd really appreciate you hitting that like and subscribe button for future content like this. But when it comes to investing into funds, if you are looking at an actively managed one where a fund manager picks the actual stocks in the fund, just be aware that with these, they are typically going to be charging higher fees, like ARK by Cathie Wood that has a 0.75% expense ratio, which, just for future reference, the annual returns that you're going to see when comparing these investments is going to be net of expenses. But if we just assumed, for example purposes, that an actively managed fund grew 9.9% of actual growth, not including the expense, then that means a 0.75% expense ratio over 30 years would cost you $146,000 in fees, reducing your end portfolio to be $924,000. Where if we were to compare that with the S&P 500 at the expense of 0.03% with VOO, just to keep things consistent and saying that growth was 9.9%, that means after 30 years, your total cost would be just over $6,000 in fees, leaving you an end portfolio over $1 million. So that's roughly a $140,000 difference in fees, where the S&P Dow Jones indices showed that investors saved more than $400 billion in fees with index funds over the past 25 years. And from the examples I showed, that is assuming that an actively managed fund can still get the exact same returns as the S&P 500 500 over time, which there are many research studies that show actively managed funds over time underperform a simple index fund. In fact, it was reported that 88% of active large cap funds failed to beat the S&P 500 over the last 15 years by the end of 2023. And even over a shorter term that is 3 years, 80% still failed to beat the benchmark. Which besides that, between 2013 to 2022, 90% of funds picked more losing stocks than winners. And because of Warren Buffett's confidence in index funds, he actually bet $1 million that the S&P 500 would outperform hedge funds over a 10-year period that was from 2008 to 2017, where the S&P 500 totaled a 125% return, where the others were nowhere near it. But we may want to consider the fact that this was right after the lost decade, where the S&P 500 did not have any gains from a 10-year period. Although going a full 10 years of no true gains is a crazy statistic, if you are consistently doing this over time, it is proven to build wealth for many investors, and it's one of the most simple and easiest things that you could do to invest your money. And it could be among the simplest, easiest, and best overall choice that you could do for investing your money over time. Which, before we discuss further on this, I want to thank the sponsor of this video, Moomoo, where you can invest on their platform and even earn an 8.1% APY on your uninvested cash for a limited time as a new user, which it is also FDIC insured up to $1 million. If you didn't know, Moomoo is a free investing app where you can trade stocks, ETFs, and even options. There are no trading commissions or contract fees on equities, plus you get access to an insane amount of data and news to help you advance your investing knowledge, which currently new users can earn an 8.1% APY on your uninvested cash for a limited time, which pretty much allows your money to earn interest while you're planning for your next investment. With their app, you can benefit from many of their tools that they provide, where one of the ones that I really like is their ETF comparison tool, where you can compare data among any ETFs you'd like, which they also have nearly any other investing feature that you can think of, all on the go. If you are one just looking to test things out, they actually offer a paper trading feature, which is pretty much a stock trading simulation where you can invest fake money to see how your investments would perform over time. Their mobile app also has many features that you can customize to what suits you best, so after a few minutes of familiarizing yourself with their platform, trading should be a breeze. So to join the 24 million users that are already on Moomoo, if you click the link in the description below and get started, you can get up to 15 free stocks when making a qualified deposit. Thanks to Moomoo for supporting the channel, but when it comes to individual stocks, you may have heard of others that invested into Nvidia, where over the past 5 years, it has grown 2,600%, which would have made a $10,000 investment grow to $272,000 in 5 years. Or for those that bought Apple early on, since 2003, it is up 93,000%, which would have turned $10,000 into $9.3 million. Sounds amazing, but what are the actual odds of you buying that investment that long ago and holding it on this long without selling or having any sort of decisions that come up because of market fluctuations or things in your personal life? And on top of that, other stocks that you may have invested into may have declined significantly. Personally, I find very often that someone has one stock do very well and then another that does poorly, and then they just pretty much even out and there was not significant gains. But if you love a company and see a huge potential for that company in the upcoming years, there's no reason why you should not invest into what you want. Just understand the increased risk here, because a great example is my dad, who worked at GM, General Motors. Back in 2009, they filed for bankruptcy, where some of the employees that he worked with lost a ton of money, and some of them even lost all their retirement savings. Some kept all their retirement in GM stock because they loved the company so much and they believed in it and they've given their whole life to working for the company, and others bought even more of GM stock because they saw it at a discount and then could have believed that there could have been significant returns if there were to be a bounce back. There is a ton of risk when investing into individual stocks if you don't know how to handle your personal finances, but many of those employees that he worked with ended up having to work for many more years where they could have retired 10 years earlier. And although I'm not a financial advisor and you have to make your own financial decisions, crazy enough, there are research studies out there that show a blindfolded monkey throwing darts at a list of random stocks could actually select a portfolio just as well as ones carefully selected by experts. And unless you're Warren Buffett, I would definitely take caution. But by no means is picking stocks a bad idea. If you have the time and energy and you like doing the research, there is nothing wrong with doing it, especially if you have the cash that is safely stored where you can afford to take on more risk, because that additional risk could potentially lead you to additional reward. Personally, I highly recommend keeping the allocation to individual stocks at a low amount when compared to my core, the foundation to a portfolio that would be index funds. The whole reason I decided to make this video is because the first few years of my investing career, I tried to outperform the market by picking individual stocks where some of them did very well and others did poorly, and in the end, they did all right, but strong index funds would actually have done better. So I like to think of this experience as you live and learn, which I really hope this prevents you from making too many mistakes and taking on too much risk with your investment, but understand that there still is opportunity ahead with individual stocks. By no means do you even have to invest into individual stocks. A simple way would just be index funds, and you don't have to spend any time or energy on your investments at all. But I will say, no matter the market conditions, if and when you are investing into individual stocks, to always expect for the worst rather than the best. Especially with a large portion of all the money that I'd have, I would much rather be safer than sorry. And also remember that when you hear things about how great an investment is and that you have to get into it and it's all over the news, majority of the time you're probably too late and you would actually end up losing money. Because of that, something extremely valuable that changed my entire view on investing into the market was from the billionaire Ray Dalio, who said trying to time the stock market is harder than competing in the Olympics. He then goes on to discuss how his firm, Bridgewater, spends hundreds of millions of dollars a year to gain a competitive edge, yet it is still extremely competitive. Where if we flip things and look at Warren Buffett, he actually says that for his wife, after his passing, he is going to have set 10% into short-term government bonds and then 90% into the S&P 500, specifically through Vanguard. That is literally advice coming from one of the best investors of all time, which, while speaking about Vanguard, if we look at John, also known as Jack Bogle, who was the founder and CEO of Vanguard, who actually helped toward the movement of creating the first index fund, he famously stated, "Don't look for the needle in the haystack, just buy the haystack." With that said, if you are interested to learn more about investing into the stock market, I made many more videos related to this kind of content, which I'll have linked in the description below, as well as free learning guides that I created, which I think you'll find great value from, especially my index fund cheat sheet. Which, while you're at it, if you want to see exactly how I allocate each of my investments and other exclusive content, consider checking out the Patreon that I'll have linked in the description below. And as always, don't forget to hit the like, subscribe, and notifications button for future content like this.